In 1975, while Wall Street's titans chased fortunes through high-fee mutual funds and speculative bets, a quiet actuary named John Bogle sat alone in Valley Forge, Pennsylvania. He wasn't building a flashy hedge fund or timing the market. He was rewriting the rules of capital itself. This is the story of Vanguard Group. Not a saga of bold gambles or charismatic founders, but a precise financial machine that has quietly amassed over $9 trillion in assets under management. By 2024, it powers 1/3 of America's retirement savings. Its secret? Turning investor psychology against Wall Street's greed, 1 basis point at a time. Bogle entered finance in the 1950s as a Princeton student, analyzing mutual funds for his thesis. What he found shocked him. The industry, dominated by high-cost active managers promising outperformance, was a wealth extractor. From 1962 to 1973, the average mutual fund returned 13.6% annually, until fees. After expenses, it dropped to 9.7%. The S&P 500? 10.1%. Managers weren't beating the market. They were beating investors with costs. Bogle's epiphany. Capital doesn't grow in isolation. It flows through intermediaries, and Wall Street was siphoning it. By 1974, as Wellington Management's star rose, then imploded in a merger gone wrong, Bogle was ousted as CEO. Fired at 45, he fought back legally, wresting control of the fund. But instead of revenge, he proposed something radical. Mutualize the firm. No external shareholders, no profit motive. Vanguard would be owned by its funds, which were owned by investors. Fees would plummet, capital would compound, for the investor, not the middleman. May 1st, 1976. The Vanguard 500 Index Fund launches with a whisper. Wall Street laughed. Why track the market when you could beat it? Active funds charged 1.5 to 3% for expertise. Vanguard, 0.5%. Critics called it Bogle's folly, un-American, commoditizing investing. But Bogle understood investor psychology. Most chase alpha, ignoring beta. Studies showed 85% of active funds underperform their benchmarks over 10 years. Fees compound silently. At 2%, $10,000 grows to $56,000 in 30 years. At 0.1%, $110,000. That 1.9% gap? $54,000 vanished into fees. Capital redirected from savers to suits. Vanguard's first decade was brutal. AUM crawled to $1 billion by 1986. Markets crashed in 1987, Black Monday. Active managers boasted survival. Index funds were blamed for passivity. Bogle persisted, launching bond funds, international exposure. Capital began moving. Retail investors, tired of underperformance, trickled in. By 1990, Vanguard hit $100 billion. The formula? Low costs create gravity. Investors stay, compound, refer. Wall Street's high fees? A psychological tax on hope. Enter the 1990s tech bubble. Wall Street's mistake repeated. Active funds piled into dot-coms, fees justifying vision. Returns soared, then evaporated. Nasdaq fell 78%. Active funds lost 20 to 30%. Vanguard's index? Minus 19%. Survivors noticed. In bull markets, greed blinds to costs. In bears, reality bites. Behavioral finance explains it. Investors anchor to recent highs, overpay for hot managers. Bogle's antidote: own the haystack, not the needle. Financial crisis 2008, the ultimate stress test. Banks levered capital 30-1, derivatives imploded. Active funds froze, redeemed. Vanguard's structure shone. No external owners pressuring short-term sales. AUM dipped, then rebounded. By 2010, passive funds overtook active inflows. Why? Psychology. Post-crisis, trust evaporated. Investors sought simplicity. Set it and forget it indexing. Vanguard captured it. Fees now averaging 0.08%. Capital velocity shifted. Trillions flowed from high-cost active, Fidelity, T-Row, to Vanguard's at-cost model. A single percentage point? On $1 trillion, that's $10 billion annually. Reinvested, compounding to empires. Bogle stepped down in 1996, but Vanguard's machine endured. Mistake 1: Wall Street's agency problem. Fund managers, paid on AUM, grow assets at all costs, launching 10,000-plus funds by 2020, most mediocre. Vanguard, 400 funds, laser-focused. Mistake 2: leverage illusions. LTCM's 1998 collapse showed genius fades. Indexing doesn't. Wealth lesson: capital efficiency trumps speculation. Bogle's $80 million fortune? Mostly Vanguard shares, gifted back. Contrast BlackRock's Larry Fink, $1.2 billion from fee extraction. Vanguard proves ownership alignment redirects capital to investors, trillions preserved. By 2017, Vanguard surpassed $4 trillion. ETFs launched, 2001, accelerating flows. Global expansion, Europe, Asia. Investor psychology flipped. Millennials, scarred by volatility, embraced low-cost beta. Result? Vanguard's 30% U.S. market share in indexing. 2022 tested the model. Inflation surged, bonds cratered. Active managers touted flexibility, most still lagged. Vanguard's lesson? Diversification isn't sexy, but it's anti-fragile. Capital mistake. Recency bias. Investors dump in downturns, buy highs, eroding 4% annually to behavior. Vanguard's behavioral edge? Stickiness. Low fees reduce churn. Structure discourages timing. AUM hit $8.5 trillion. How money was made? Not trades, but retention. One client staying 30 years at 0.1% versus 1%? $500,000 extra per $100,000 invested. Scaled? Trillions. Global ripple. Australia's super funds mimic. Europe's UCITS adopt. China's retail indexing booms. Psychology universal. Fear fees more than markets. Wealth lessons extracted. 1. Costs are capital's silent thief. Audit every basis point. 2. Psychology destroys returns. Index to bypass it. 3. Ownership matters. Align incentives. Watch capital flow to you. 4. Patience compounds. Vanguard's $9 trillion from decades of discipline, not decades. Wall Street's errors? Chasing alpha, ignoring math. Vanguard's? None fatal, because it owns none. Bogle died in 2019, but his alchemy endures. Trillions move through Vanguard daily, not to moguls, but to futures. In a world of influencers peddling quick riches, Vanguard whispers, capital builds empires through subtraction. Subtract fees, subtract ego. Let compounding do the rest. The hidden formula? Simplicity scales. If this changed how you see money, subscribe. These documentaries are built for thinkers, not spectators. And if you're serious about mastering capital, watch the next video on your screen.